Hi everybody, Thomas Castelli here with the Real Estate CPA, and next time you speak to your CPA, you're going to want to ask them if the business interest limitations that were enacted by the Tax Cuts and Jobs Act are going to affect you. And this will most likely affect real estate investors who are either syndicators themselves or invest in syndicates as a limited partner. And that's because the business interest limitations limit the amount of interest you can deduct to 30% of your adjusted taxable income. And this does not apply to businesses that are under $25 million in revenue unless you are a tax shelter. And a tax shelter is defined by any business that allocates 35% or more of its losses to limited partners. And this is often the case with syndications. And being since that real estate is such an debt heavy business, there's a lot of interest that you want to deduct, and that interest deduction becomes very important to investors. Now, there is a way you can mitigate this business interest limitation, elect out of it by electing to be taxed as a real estate trader business. However, when you elect to be taxed as a real estate trader business, you have to depreciate your property over the ADS system, which is not as advantageous as the MACR system that uses accelerated depreciation that most investors use. The depreciation schedules are longer, and there may be a situation where you can't use 100% bonus depreciation to depreciate your 5, 7, and 15-year property. So again, you're going to want to ask your CPA, are you affected by the business interest limitations, and how you can work around them, and what strategies and plans you can put in place to maximize your tax deductions for you or your investors. If you want to learn more about the business interest limitations, head on over to therealestatecpa.com. And if there's any way that we could help you out, we would be happy to do so. See you over there.